Hello and welcome. You're watching All About Your Company. I'm Hersh Sayta, and today is going to be a very interesting management that we're going to speak to, because this is a company which has given a 121% return in 2025 calendar year. It's been a phenomenal journey. What next is really the question. In fact, the last 6 months also have been stellar, 46% higher on that L&T Finance stock that you can see on your screen over the last 6 months. So it's been a fabulous ride. Question is that you've got a 2.9 times book is what L&T Finance trades at currently, trailing 12 months, 2.5 times 1 year forward, and you have a guidance of 2.8% in terms of ROA. Is there scope for more upside here is really the question, and we'll try to understand what the risk could be to that upside as well. And we will have Mr. Roy joining us live in the studio today to give us a sense on how he feels the roadmap could be. The next 3 years growth. Now, mind you, this is a company which hasn't grown as quickly as it ought to have, but that is only on the basis of the AUM. And that is because they've run down their wholesale book over the last 3 years. So you might not see exactly a very, very strong growth in terms of the absolute number. But beneath that is a very strong undercurrent of retailization, and that growth has been extremely strong. And that's what the street seems to be rewarding. And therefore, I'd want to understand what the next 3 years could hold, because now you're at 98% retailization on the full book. Really, now is there a turnaround with regard to where the loan book goes, and can it grow at a steady state, continue to grow in terms of what it has done over the last 3 years? The second piece is, what are the levers for growth? Are they going to target new geographies, a new set of customers? Is there going to be a slightly new lending practice that they're going to do? We'll try and understand that as well. The third piece is credit cost. Now, credit cost has been a concern in the past. In fact, the guidance today is 2% odd in terms of the aspirational credit cost number. MSME, MFI, some of the segments that it does have the trend of cyclicality, and therefore it suffers that possible drawback. But what happens and what is going to change over the next 2 to 3 years is what I'd want to know. Is there a renewed confidence with regard to maintaining that credit cost number between 2 to 2.5%, and how comfortable is management to guide that? When will the current credit cost taper happen? Because you're already in a cycle. Will it happen fairly quickly? Will it take maybe 2-3 more quarters? That's the other piece I'd want to understand. I'd also want to determine, based on disbursement momentum, as to whether the confidence with regard to lending, especially in microfinance, has come back or not. And that will give us an indication also as to how credit cost does. So we'll get all of that perspective. The fourth piece is OPEX to assets, and that is the other lever for ROA. Apart from recoveries, of course, the OPEX to assets is the other lever. Can that start getting better in terms of as L&T Finance scales its book higher? That's the other piece. How consistent is the ROA is really the question that the street will want to ask. Currently at around 2.4, 2.5%. The goal is to reach 2.8 to 3%. How quickly do they get there? But OPEX to assets is just one of those levers which will help them get to that 2.8 to 3% kind of ROA band, along with credit costs. So when we speak with Mr. Roy, this is what we'll probably quiz him on. Now, let's get into our segment, which is to understand what L&T Finance does. First off, it's a retail NBFC now. It's part of the L&T group, as one would expect. It's a diversified rural and urban lending platform now, with 98% of the book in retail assets. It has a pan-India presence, around 2.5 crore odd customers. It prides itself on being tech first. Of course, the benefits of which we will only see over the next 2, 3, 4 years, and the uniqueness of which we will quiz management on. And in terms of the credit rating, it's a AAA rated company, and therefore your cost of funds will be decently low, and that's what you want to keep your eye out on as well. In terms of presence, 21 states, 4 union territories, around 2,600 odd branches is what it does. Rural is around 2,200 branches, so predominantly rural where this one is concerned. It covers over 2 lakh villages and has 345 urban branches as well, where it covers 400 plus cities and towns. So has a large presence in terms of physical presence. In terms of states, a large part of its book also comes from For example, a Bihar, UP, Tamil Nadu, Maharashtra, and Karnataka. Those are just some of the states, key states in which it has a presence. It's now started doing gold lending as well. Let's talk about products. While I'm talking about gold lending, the products, rural business, it does rural business finance through joint liability group loans to women, micro loans against property which are secured, and pan-India, it has a rural presence of around 2,200 branches. We spoke about that. Farmer finance, tractor finance, equipment loans via dealers is what they do. Warehouse receipt financing also is what they do post-harvest. And they are present in this line of business in 16 states. They have 2,500 dealers who they push their loans out through. Urban finance is around is predominantly two-wheeler loans, which are pretty much entirely digital. There's also home loans, loans against property, personal loans via partnerships with a Google Pay and the like. And then you have urban branches at around 345 branches currently across 400 cities. We spoke about that. And the last piece is SME finance. They do loans to professionals, traders. They do supply chain financing. 200 plus locations is what they have a pan-India presence in. Gold finance is the new one, where they have secured gold loans is what they give. And they currently do that out of 130 branches out of the existing near 2,600 branches that they have. Now let's talk about the metrics, and there will be 8 metrics we'll talk about. We'll start off with the P&L account, where net interest income comes into the picture. You see the kind of growth that they've done on the NII account. NII has grown at around 13% over the last 3 years on a CAGR basis. Impairments on a very, very high base of nearly 1,700 crore. Impairments currently at around 2,200 crore at the end of FY25 have grown at just about 9%. But the base was extremely high in FY22. That's something you want to keep in your mind. When you're looking at net profit, the growth has been very strong, largely because credit costs haven't grown as quickly as incomes have grown. So 35% is what it has done with regard to your profit after tax CAGR growth over the last 3 years. Now, in terms of how Q1 and Q2 have been, impairments or provisioning has been elevated. That's one of the concerns. But outside of that, it's been a fairly steady quarter where top line is concerned and where growth is concerned. It's come in well. 18% growth is what it has done over the last 1 year at the end of Q2 FY26. Your expectation ought to be 20 to 25%. We'll quiz management as to whether that can start to kick through in H2 itself. Now, let me talk a little bit about growth. And in terms of the AUM, it has grown from around 86,000 crore to around 1.07 lakh crore currently at the end of Q2 FY26. But out of that, around 1.05 lakh crore is what the retail loan book is. So what we've seen is that retail loan book is the crucial piece. That's what has really grown faster, because there's been a rundown on the wholesale book. That's something to keep in mind. So while the last 3-year CAGR of the AUM is just 4%, but you have to contextualize this. There's been a rundown of the wholesale book and a run-up of the retail book. And due to that, there's been very strong retailization, which has happened over the last 3 years. I've seen it unfold myself. And it's been a very good journey in terms of retailization, in terms of replacing the wholesale book with the retail book. That's something to keep in mind. But you look at the other key number, 34% CAGR on the disbursement growth over the last 3 years. That is what signals the kind of momentum, underlying momentum that the business has seen, where the wholesale loans have been replaced by the retail loans. Capital adequacy continues to remain steady at around 22%. That's broadly the current capital adequacy. Now, let's talk about operational metrics. In terms of yields, around 15% is what they lend at. Cost of borrowing is around 7.5%. And NIMS plus fees, which is how they quantify the margin that they make on their products, is around 10% odd. When you're looking at credit cost, the credit cost has been choppy between 3.5% to around between 2.5% to around 3.5%, but it's starting to get steady, and we'll try and get a sense as to whether it can remain that way. Last piece is with regard to ROAs. ROAs, as a result of the credit costs, have also been choppy. Steadiness on this front also is what we will quiz management on. Let's talk about asset quality now. Gross stage 3 has been between around 3% to 4.5%. The aspiration is to get it down to 3%, gross stage 3. And net stage 3, which was sub 1%, has spiked up again because of problems in the MFI space, which is cyclical, right? But the aspiration, again, is to be at 1%. Let's talk about ROEs, which were 5% when Mr. Roy took over. It's currently at around 11.5%. it will likely continue its journey higher, and how much higher and how quickly will be the question. Let's talk about shareholding. The single largest promoter is Larsen & Toubro, which is 66%, or rather holds 66% of L&T Finance. As of September 2025, very, very steady in terms of holding. No concerns there. FIs, DIs hold their pieces as well, and so does the public. The number of public shareholders have been choppy. That's something you want to keep your eye out on. When there's exuberance, you will see shareholders spike up, but that's not happened, at least over the last 6 months or so, despite the stock price spike. In fact, 8.5 lakh shareholders is what they had in March of 2025. Now they currently have sub 8 lakh shareholders on their book. Now let's talk about valuations. When you just break it down, 105 rupees a share is what the book value is. Current market price is around 300 rupees a piece, and therefore comes to around 2.9 times current book value, 2.5 times 1 year forward, based on Bloomberg consensus analyst estimates. Let's also talk about what the analysts are viewing the stock as. 15 buy calls on this one, 2 holds, 4 sells, with a target price of 283 rupees a piece. That's broadly the take with regard to L&T Finance. But let's go across. We have Mr. Roy with us to talk to us about exactly how the journey is going to unfold. Mr. Roy, let me first start off with the loan book itself. And firstly, thank you so much for coming in person and speaking to us.
Thank you for the opportunity.
Right. Mr. Roy, give us a sense first. You're currently at around 1 lakh crore, if I can round it down. How quickly do you get to 2 lakh crore, and how confident are you of getting there?
So I think we are reasonably confident of getting there as fast as possible. So what we have guided is that a growth rate of about 20 to 25% AUM growth rate through the years. And I would expect that, we would get to that 2 lakh number anywhere between the next 2 to 3 years.
Okay.
It depends. Obviously the caveat is that you should have some amount of benign operating conditions in most of the lines of business that we do. But given the fact that the economy is doing well and most of the lines of business that we are operating in are showing very, very good forward trajectory, very, very confident of getting there somewhere between the next 2 to 3 years mark.
Okay, so 2 to 3 years at 2 lakh crore. What are your levers to get there? You've done plenty of things, right? You've done gold loans now. You've started off with gold loans. You're also doing loans through fintechs, through partnerships, fintech partnerships.
Yes.
Which are relatively smaller in size. So fintech is around 1,000 crore in terms of the size of the book, if I'm not wrong. And gold loans also is in around the same number. Talk to us about how sharply do they contribute to when you get from 1 lakh to 2 lakh crore.
So first, I will take the the digital partnerships that we have.
Sure.
The digital partnerships are quite large right now. Actually, if you see in digital partnerships, we have now operating partnerships with Google Pay, with Amazon, with PhonePe, and SuperMoney has just gone live.
Right.
So our monthly originations actually through these partnerships are about 500 to 600 crores right now.
Okay.
And the book size would be roughly about 4 to 5,000 crores right now.
Oh, okay.
So the book size is much larger.
Sure.
It's much larger. Gold loans, the book size was relatively small. As you will recall that in the month of June this year, we acquired a boutique small gold loan company with about 130 branches and roughly about 1,000 crores worth of book size. I think we have done pretty aggressive expansion after that.
Okay.
So we are adding 200 new branches this year itself.
Right.
So from 1st of October till 30th March, we'll be adding 200 branches. So exit FY26, we will have 330 branches.
Okay.
And for every single day of next year, we will add 1 more additional gold loans branch. That means we have taken a target of adding about 330 to 350 gold loan branches next year.
Okay.
So the growth targets are pretty strong in this business, and we do expect that exit FY27, we should have a book size of anywhere between 5,000 to 6,500 crores in the gold loans business, which is right now about 1,500 crores.
Okay. So you will 4x your gold loan business in the next 12 months roughly.
In the 12 to 14 months, we should be able to do that.
Understood. And okay, so if I can just add a couple of questions here. One is with regard to your number of branches. This branch growth of 130 to around 350 that you're targeting by end of FY26, is that on the existing branches, or are you going to open new branches?
All new branches.
Gold loans?
All new branches.
What is the strategy there, sir?
See, one of the things we looked at is that we have a very large microfinance book, right? We have almost close to 65 lakh active borrowers of microfinance. Now, we looked at their gold holdings, we looked at our tractor business, their gold holdings, we looked at our two-wheeler business, their gold holdings. And the number is quite large actually. The amount of outstanding gold loans borrowed by our customers is upwards of, especially in the microfinance business, is upwards of 18,000 crores. In the two-wheeler business, it's upwards of almost 10,000 crores. So overall, it works out to about 35,000 crore pie. So we say that why don't we partake part of that? So we are going to open the branches in which our customer footprints are stronger. So what we're going to focus is on the eastern region. We are very strong in eastern region in microfinance. We're the largest microfinance lender in Bihar. We are very strong in West Bengal, relatively good presence in Odisha, very strong two-wheeler presence in Assam, West Bengal, Bihar and Odisha. So that is the region in which we are focusing on initially for our gold loans footprint. Apart from the traditional footprint of the company that we bought, which was in the north as well as in the east, in the west. So these are the three locations that we are going to first sort of expand in, with a very few initial branches in the south. Because south, the competition is intense, so that is where we want to go the last. Right? But so you will see expansion in east, west and north, followed by some expansion in south next year.
Got it. But not on existing branches. These are fresh. So
not
again,
on existing branches.
What's the thought process there? Because you have existing customers with almost 20% of your book sitting in other branches or other financial institutions or lenders being gold loans. So why not on existing branches is what I'm trying to understand. Or will you implement it over a period of time?
See, there are certain existing branches where we are introducing gold loans as well.
Understood.
For example, we had certain micro loan against property branches. We are also adding gold loans to that, right? However, because the thrust of focus of expansion was in the eastern side, right? And many of our branches, especially, we have two sort of formats currently. We have urban branches which cater to, two-wheeler, SME, home loans, personal loans, etc. And we had what we call meeting centers which cater to MFI. Gold loans typically is a semi-urban play, and that is where we had this gap of these branches. So we are putting these 200 branches in the semi-urban towns.
Understood.
But also what we are doing is that a portion of these branches, about 30-40% of these branches will become something which we call Sampurna branches. That means they will not only do gold loans, but they will do all other products.
Understood.
And we are trying to rely on cross-sell. So our microfinance colleagues, our microfinance sales force who are in the field, actually will also generate lead for gold loans and send these customers to the headquarter town in which the gold loans branch is. So we have about 20,000 feet on street, and what we are trying to do is force multiply the power of this 20,000 feet on street to generate gold loan leads and send them to the nearest branches.
Okay. If I were to zoom out, FY27 you get to 6,000 crore in terms of gold loans, you'll probably get to around 1.3 lakh crore in terms of your loan book, because you'll do 20% growth from here conservatively. If I were to just push that number forward and try to understand FY28, when you're at around 1.6 lakh crore or 1.7 lakh crore in terms of AUM, what will gold be? Can it continue to grow at this pace?
See, I do believe that gold will continue to grow because of the customer base that we have, and we will continue to mine a large proportion of that customer base. Plus also the branch distribution. As I said, next year we're going to do another 350 branches. So we're going to deploy over the next horizon of next 3.5 years, we'll deploy anywhere between 1,500 to 1,700 additional gold loan branches.
Understood.
So as the branch, and see, average AUM the gold loan branch, a fully functional gold loan branch can be anywhere between 7 crores to 15 crores, depending upon the catchment size, right? So if I take an average of 10, crores per gold loans branch on a fully mature basis, then 1,500 branches, you are talking about a 15,000 crore AUM.
Understood.
Right?
So you will become significant in terms of the size to gold loans. Your yields will likely be better than what they currently are in the gold loan space?
Right now, we average between 19 to 20%, depending upon. So we'll try to maintain at that particular level.
Fair point. So, and that means it's NIM accretive for you.
It is NIM accretive, and that is also one of the reasons. When we looked at our asset profile was very unsecured heavy. You had microfinance, which was unsecured. You had personal loans. You have SME unsecured business loans, right? So it was very unsecured heavy. So you wanted to have a high yield secured product in our portfolio mix.
Right.
And obviously gold loans was a sort of a very nice fit there, right? And an acquisition opportunity presented itself at an attractive valuation, and we picked it up. And this acquisition actually cut our time to scale by almost 24 months.
Understood.
Right? And we've been able to just ratchet it up after the integration of that business.
Understood. You're currently at 2.4, 2.5% in terms of your credit cost.
Yes.
How quickly do you think it gets to 2%? Because that's your aspiration.
Yeah, so we have been doing a couple of things on this. First and foremost thing, microfinance had a bad asset quality cycle last year. The average industry loss rates were anywhere between 8 to 12% depending upon the player. Ours was about 3.8%. So in a way, we were order of magnitude better than the industry. But still, it hurt, right? It hurt because it had a impact on the running of the business. So I can tell you that this quarter, we are seeing significant normalization of the business. So microfinance business has actually started growing.
Okay.
Right? So overall, I do believe that all the lines of business will go pretty strongly. Gold loans will grow, two-wheeler will grow, microfinance will grow, and credit costs, because of the implementation of our proprietary engine like Cyclops, in two-wheeler business, we have seen a significant paring down of sort of the forward indicators of credit cost. I'll give you one example. In the pre-Cyclops book, right, which is Cyclops is our sort of three-dimensional AI-driven credit engine. In pre-Cyclops book, our sort of bounce rates on the two-wheeler portfolio used to be anywhere between 20 to 22%, and that's typically the industry bounce rate. In our Cyclops book, which is about 8,800 crores of our portfolio right now, right, the bounce rate is between 6 to 8%. So it is 3 times better. So, a business which was a 4% credit cost business or a 3.5 to 4% credit cost business, especially for the industry, I do believe with such advanced tools, which we are using right now, it is possible to bring that closer to 2%. So microfinance will continue to improve, two-wheeler will continue to improve, tractors, we are seeing great performance after implementing Cyclops. SME on the sub 10 lakhs, there was a spike in credit cost that is quite controlled right now. So I believe that over the next 2 to 3 quarters, you will see that credit cost inching closer to that 2 to 2.2% margin, right? And what we have said is that we should see a credit cost closer to 2 to 2.2%. Exit FY27 is what we should get to.
Got it.
So right now we are at 2.98. Without macros, with macros, we were at 2.41.
Correct. Okay, if I were to, again, now we'll have to be a little faster because we're slightly short on time. When I'm talking about recoveries from the wholesale book,
yes,
that's the other lever which you'll rely on. How large, how quickly?
See, recoveries on the wholesale book is, and we have some of our assets in asset reconstruction companies, and especially many of the residential assets where there were execution issues, many of them, especially in the Noida belt, etc., and some parts in the Gurgaon and NCR belt, actually have started their movement towards resolution. And some of the land holdings that we are like inching closer to sale of those land holdings. I believe that the cash flow from the wholesale assets will start in about another 18 months of time.
Okay.
Right? And whatever over recoveries that we have, we will use them to build macroprudential provisions.
Which will be how much?
See, we want to get to about 1,000 crores of macroprudential provisions, which is roughly about 1%.
But you've done much more than that in terms of provisioning.
Yeah, so we had about 975 crores, which we...
no, I'm talking about the wholesale provisioning which you've done.
That is much more.
Correct.
Our wholesale provisioning is about 65 to 70%.
Correct, exactly. So therefore, you should recover far more, right?
Yeah, so, the fact is that many of these assets have a long recovery cycle.
Sure.
So we are being conservative about it.
Sure.
As of now, our first guidance is to get to about 1,000 crore macroprudential pool out of the over recoveries. But if we have more recoveries, we are happy to build more pools as well.
Understood. And with regard to OPEX, that's your other lever.
Yes.
How much can you trim it down and how quickly again? Because that's, again, been very sticky for you, right?
Yes. So you see, if we have guided on OPEX plus credit cost as a 7% block. Our OPEX is right now about 4% cost to assets.
Correct.
Our credit cost is about 3%, 4 plus 3%. So now, what we have guided is that we will try to move this 7% closer to 6%.
Okay.
Right? So, see, OPEX at 4%, we are investing a lot in technology. We are investing a lot in opening up of the new branches. I talked about the 1,500 to 1,700 new gold loan branches that will open.
Yes.
Right? So OPEX, I will think will remain at that 4% level for the next 18 to 24 months. However, there will be efficiencies in the credit cost, so that 4 plus 3%, 7% block should move towards 6% as the credit cost starts moving from 3 to 2%.
And confident of 2.8 to 3% ROA maybe FY27 or FY28?
We have said that exit FY27, that means Q4 of FY27, we will try to get to about a 2.8 to 3% credit cost, ROA trajectory.
Correct.
And as of now, given the trajectory that we are seeing, we remain reasonably confident that that should be possible.
Thank you so much, Mr. Roy. You've come in and spoken to us very candidly. And viewers, I hope this has been very insightful for you as well. But with that, completely out of time on this edition of AAYC. Thank you so much, sir, for coming
Thank you
in
for
and
the
speaking with
opportunity.
us. And thank you so much, viewers.
Thank you.